All right, we're here with Logan Mohtashani. Logan, maybe just to get us started and to set the table, walk us through your background and your current role.
Currently, I am the lead analyst for HousingWire. I started doing that job around toward the end of 2019. A lot of people know me for my financial blog that I started back in 2010. I started just kind of tracking housing economic data. But then by 2015, I made it into this more kind of a data analyst, really focused on economic expansions with a tilt toward housing economics. One thing led to another, and I became kind of like a chart nerd on social media. And I'm just kind of a pure data person. I used to work in the mortgage industry. I retired in 2020. So pretty much at this point, all I do is look at data 24/7 with just a pure mathematical data sense, not any kind of ideological or investment kind of premise, just trying to show the historical models of economic cycles and expansions, recessions, and try to talk about housing economics in its all traditional form, which isn't the most exciting, but in this day and age, it could be kind of useful.
Sure. Yeah. So, I came across your work on Twitter. I have long had an interest in the drivers of housing economics and housing prices. And I think your work represents a really novel contribution. So that's my motivation for having you on the show. So thanks again for joining us. So maybe let's get started with kind of the current situation, but I know that it goes back a few years, and I want to focus on something that you sort of keep repeating, which is that we currently have what you characterize as a savagely unhealthy housing market. And you go through in quite a bit of detail in several articles why you think that's the case. So maybe just walk us through some of the fundamental data points and drivers of your case that you're observing and why you think the housing market is savagely unhealthy.
So to understand housing economics, you have to almost, in a sense, go back to the previous expansion. And when I started talking about housing economics back then, I've always said, and I've separated my work into two periods, 2008 to 2019, and then 2020 to 2024. And in the past, I said we would have the weakest housing recovery ever. And recovery is not prices. It's new home sales, it's housing starts, it's mortgage demand, mortgage debt. Mortgage debt adjusting to inflation is not even positive from the peak of the housing bubble years. So you kind of work your household formation, right, all the way up until years 2020 to 2024. So the theme is that Americans are very easy to understand. They rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. Housing was always going to be a years 2020 to 2024 story. So we work our way all the way up to 2020. And then here's the first 2 months of 2020. Housing authentically broke out in February of 2020. Housing starts, permits, purchase application, everything kind of broke out of the pre-cycle trends. We got that data in March, which means we're dealing with the COVID, right in the heat of COVID. So then going back to the premise, demographics is economics. Years 2020 to 2024 has the biggest housing demographics ever right now, currently ages 28 to 34. You have good replacement buyers. There is one problem, though. Total inventory in America, if you go back to 4 decades, is usually 2 to 2.5 million. That's the active listings if you want to use the NAR data. The only time in history where we really broke out of that trend was the 2006 to 2011 period. That was forced credit selling. And I think a real key thing to my work is credit risk profiling. In 2005, 2006, 2007, and 2008, people were filing for foreclosures, bankruptcies. Then the job loss recession happened because the financial debt boom that we saw in residential lending was enormous, something we've never seen in history. And those debts were what I call exotic loan debt structures. They're not really designed to be fixed long-term products. So after the housing credit crash post 2010, we ended up facilitating the best loan profiles ever in history. So when you think of housing or credit, you think of fixed debt product, rising wages every year. So from 2010 and on all the way down, to 2021, we've had 3 refinance waves people are staying in their homes much longer. From 1985 to 2007, it was 5 to 7 years. From 2008 to 2022, it's about 11 to 13 years. In some parts of the US, it's 15 to 18 years. I've been in my house for 18 years. So here comes 2020. Everyone went into housing crash, world depression, everything. By April 7th, I wrote America's Back Recovery Model for HousingWire, which everyone thought was crazy back then. Even HousingWire thought about maybe we shouldn't publish this. It was a recovery model designed with dates and things to track, because what I think the mistake a lot of people made, even my economic friends, they saw the 20 to 30 million people that were unemployed and the 5 million in forbearance. They forgot that there was 133 million people working still. So it's not like you need 60 or 70 million people to buy homes each year, right? You roughly need about 4 million mortgage buyers. You got about 15 to 20% cash buyers. So housing should be okay. Just give it like 6 to 8 weeks. We had a V-shaped recovery. But by the summer of 2020, we had a problem. And this was the hard thing to kind of explain to people. Total inventory collapsed to all-time lows. We never even had the seasonal bump in 2020 that we do every year. And then we're heading into 2021 with all-time lows, with this major demographic patch and low rates. So what it did is facilitated really unhealthy home price growth, and something I even talked about and warned about in early 2021, even wrote an article saying, listen, we actually really do need mortgage rates to rise because this could get bad. Everyone was stuck on this kind of forbearance crash kind of thing. Even though demand was stable, they thought forbearance would crash the market. Never was going to be the case. In fact, in the summer of 2020, I labeled the term forbearance crash bros, knowing that a certain group of individuals would stay on their YouTubes and just basically say forbearance. So my job is to document why that wasn't the case on HousingWire. But as you can see, home price growth really accelerated in 2020. And then 2022 came. And this is where I created the savagely unhealthy housing market. Every October, you have this seasonal dive in inventory, right? It's the inventory usually rises in spring and summer, fades in the fall and winter. We are already working from all-time lows. And by October, we weren't even close to even having anywhere back to any kind of normal inventory. And mortgage demand had been picking up. So we were going to start 2022 in a very bad spot. So during the years 2020 to 2024, I said, as long as home prices just grew at 23% 5 years, which is like 4.6% nominal each year, we would be okay. But this period in time, there's a potential of home prices growth accelerating. So we saw that in 2020, we saw that in 2021. Then January and February came, and you just saw an economy, you saw a country just simply have too many people chasing too few homes, and mortgage rates were low. So I had already lost my price growth model, and we were seeing multiple bids everywhere. So at that point, I said, that's it, I'm done. Nothing else matters to me unless rates rise and get us off of this extreme low inventory, because we were at risk of having a really bad inflationary period for housing for 2022. And since we had started the year at all-time lows, it wasn't going to be a good year. So I coined it savagely unhealthy, because housing doesn't move like stocks. I think so many people are stuck back into the housing bubble years where the velocity of inventory, right, skyrocketed in 2006. Well, that was a credit boom, a credit bust, a forced selling. You had all these things. None of them were here. So here is rates rising, right? Rates, I always had a line in the sand. I said, the housing market will change once the 10-year yield gets above 1.94%. That's really 4% plus mortgage rates in 2022. Part of the forecast was like, this could possibly happen this year because global yields should rise. And there we go. Rates shot up. So all this price inflation you had in 2020, 2021, and 2022 early, and then you had total mortgage payments, principal, taxes, insurance just skyrocket on people, which is the biggest housing inflation hit. But prices are still rising on a year-over-year basis because we're working from all-time lows. So the levels that I've focused on just to get back to normal is total inventory between 1.52 to 1.93 million. Once we get back there, which is basically the 2019 levels, which was the 4-decade low before 2020, that's enough inventory to keep the market somewhat balanced and sane and get us off of that. So rates got up. Now that we're in August, we saw the existing home sales report yesterday. Home sales down big year over year. Prices still going. That's the savagely unhealthy part, because the velocity of inventory is much different than people think. It takes time for that to kind of work itself out. And we're still, there's parts of the area that are cracking into the 2019 levels, which I then consider to be healthy. But until we get the total market back up there, which I think we can have in 2023, you can see this unbelievable dynamic of double-digit declines in sales and double-digit home price growth on a year-over-year basis, which actually goes back to the previous expansion. We've had times where rates rise, sales fall negative year-over-year, but prices are still rising. But we're talking about single-digit, year-over-year price gains. We're not talking about what we've seen already. The Case-Shiller is going to lag a little bit. Of course, it's still going to show about 18, 19% home price growth. So that became the savagely unhealthy housing market, because that was my biggest fear about this period, that if inventory channels have been falling since 2014, which it has slowly every year, inventory has been falling, you run into this demographic patch. If for some reason inventory breaks to all-time lows, we could be stuck here long enough to create a lot of price damage. And it happened. So for me, it's, we got to get a balanced market. There's no other mechanism to create balance in housing without, it's just basically higher rates. Higher rates traditionally work. They're just going to take longer than people thought. And we're sitting here almost in August, and we're still showing 13% year-over-year home price growth with sales noticeably declining. Not good, not a normal thing, but that's where people should have been worried about during this period.
Right. So it seems like there's multiple things that impact demand. And so I want to sort of fixate a little bit on the two. So the normal inventory is about 2.5 million homes for sale. You're saying we're currently well below 1.5 million. If we get back to somewhere between 1.5 and say 1.9 something, I believe was your range, we get back to something that more resembles equilibrium. Why would you expect to see house prices, either the gains in house prices moderate, or maybe even housing prices begin to normalize relative to incomes? For example, even if we move from current inventories to the lower inventory levels of kind of the 1.5 to 1.9 range that you're targeting, to start seeing an impact?
So whenever rates rise, it cools the growth rate of pricing. In 2013, home prices were up double digits, and then rates went to just 4%. And then we saw nominal home prices come down to about low single digits. In 2018 and 19, mortgage rates got up to 5%. Total inventory didn't grow really, but the growth rate of pricing came down so much that if you adjust it to inflation, the equivalence of rent, we actually had briefly negative real home prices in 2019, which I remember being at a conference and I was showing that chart. I was like, my God, this is great. Look, we have negative real home prices. And everyone was like, I can't sell my house fast enough. So nobody really liked it but me. But I was thinking that was like the most perfect time, because it was a very balanced market. So, and that inventory level was just 1.52 to 1.93, 2018 and 19. So historically, it's always happened where the growth rate of pricing cools down housing. The difference has been always that whenever rates rise and we see a slowdown in housing, then they fall. And that's always balanced out, the supply and demand dynamics. So we see sales pick up when rates fall. But that was working from a very normal equilibrium of home price growth and wage growth. Okay, we shattered everything during 2020 to 2021 in the early, and then now 2022, obviously. And then again, that's the fear. So just following historical trends, because the growth rate of pricing is so obscene, higher rates will work. And we're seeing it. We're seeing inventory growth. We see inventory growth in the places that had the biggest price growth. I mean, we think about it, like Austin home prices went up 100% in 2 years, something like that. That's not normal. And the crazy part is, this is the big debate I have with everyone. This, demand was good. Demand was solid. There were more homes being bought. It was nothing like the credit boom of 2002 to 2005. So how I explain to people this, the inventory was the bigger factor here. During the housing bubble years, we had more sales, more inventory, less home price growth. Here in 2020 and on, 2020 existing home sales were only 130,000 more than 2017 levels. So there's not like this big sales or credit boom. It's just inventory cracked where we created forced bidding. So we had fewer sales during this period, fewer inventory, but the price growth was so much hotter during this time. And that was always the fear that if inventory cracked and we just have a little bit more people now looking than in the previous cycle, people are going to go in and buy homes because everyone needs shelter. And then the secondary factor is that, and this was even harder to explain to people, rent inflation was going to take off. So people are thinking rent inflation, nobody can pay their rents, everything. So no, summer 2020, rent inflation is about to take off, especially in the cities. You had a little blip there where you had supply and people were getting good deals, and then rent inflation took off. Because why? Economics is demographics. You have a lot of people that need shelter. Rental vacancies have been falling. Supply has been falling. So we just got caught in a very, very bad spot, and we're all paying for it with this savagely unhealthy home price growth.
Right. I mean, it seems to me you've listed a bunch of different things that sort of should impact the rate of price growth. So you mentioned demographics, obviously. So I'm interpreting that as basically the ratio between people who are seeking household formation, so sort of young people who are getting married, want to start a family, buying homes. And at the other end, you have people that are supplying homes, which I guess are home builders and owners of existing properties, which I guess are people that are downsizing or obviously passing away or moving on to stages of their lives where they just don't need the same home, right? And that sort of facilitates housing turnover.
When you think of housing demand, you always have to think of there's the first time home buyers, there's a move up buyers, move down buyers, cash buyers, and investors. You have to put them all in a whole. So how I phrased the years 2020 to 2024, don't think of like a credit or sales boom. Just think of really good replacement buyers. And when you think of replacement buyers, that every year there's this group needs something. We just have a lot more of the younger group in right now than we've had in previous. And millennials were always the biggest home buyers in America. They just have a little bit more of this in this period. So everyone needs shelter. And there's just not a lot of product out there for rents or home buying. So it could facilitate the classic shortages, facilitate inflation. You have too many people chasing too few goods. And then you have the forced bidding action. That's what you never want to see. You never want to see forced bidding for shelter. It's not the healthiest thing ever. And then you see the consumers index to buy a home. It's the worst ever. Right. It was the worst ever in 2020, 2021, but people, it's not like they didn't want to buy homes. They just hated bidding for it. So a lot of these surveys we see, people have to buy food and gas. They just don't have to be happy about it because of the
exactly
price.
Right.
That explains a lot of the survey indexes for housing.
Right. But it seems to me that people that are just moving up or moving from one house to another, they don't require new homes, right? They're shifting from one residence to another one. What really matters, it seems to me, is those that are moving sort of out of the housing market, sort of towards end of life maybe, and those that are moving into the housing market, which is kind of primary household formation, right? It seems to me that drives the majority of kind of the supply demand equation. But then on the other side, of course, you've got the availability of credit, affordability being a combination of credit terms, the price of the actual home, and of course the rates, right? The mortgage rates. So, I mean, it seems like a relatively complicated model. How are you allowing all of these different variables to impact these expectations?
This is for me, for my work, was setting a specific period of price growth just for this 5-year period. If the price growth broke, then I go back to my secondary is the 10-year yield. Once the 10-year yield breaks, once you get 4% plus mortgage rates, if the price growth model breaks, you're going to have the biggest housing inflation hit in recent modern day history. We're having payments of people go up 40, 50, 60, 70%.
Yeah.
That's because we had a deviation from historical norms on price growth. So what happened in the previous expansion was that price growth wouldn't be that hot. It'd go up a little bit, down a little, but it was roughly in space with wages. So you didn't have that kind of fear. Here, you just had straight vertical pricing, not what you want to see. And we had it for even right now, when you look at it, it's 2.5 years. So that is an affordability hit. And when we think about supply, why does supply stay between 2 to 2.5 million? If you go back to the 1982, a traditional seller, primary resident, is a buyer of a home. So when they list their homes, they're going to see and go wherever rates are, 6.5, 5.5, 4. They feel comfortable that they can get a loan and buy another property. So in a sense, that's a wash. They get a buyer for their house and then they buy another home. So the inventory channels stay kind of normal. What higher rates do is that it slows demand enough where the days on market is the real issue here. We're still, even yesterday, existing home sales report, the year-over-year days on market fell from 17 days to 14 days. That is a bad thing. I always say, whenever days on market are a teenager or less, it's never a good thing. We need to get these people to college and get them out renting. You need 30 days so people have choices. So what happens is that was such a big affordability hit that, even for the new home sales sector in March, when it happened, I said, this sector is in risk. It'll be more evident in a few months. In the month of June, I already raised the recession red flag for the builders, because traditionally when rates rise, the builders know this. They're going to go, okay, well, we're just going to slow things down a little bit because we just want to sell our product. And that's why the two things that I thought that could really mess this 5-year period up is price growth with rates rising. Price growth, if we just grew at 3-4% every year, 2020, 2021, whenever rates rise, it does impact demand, but it wouldn't be so bad, right? Because wages grow, the hit wouldn't be so bad. That did not happen here. We just got blown out of the water. And even today, we still have double-digit year-over-year home price growth, even though sales are falling dramatically. That's the savagely unhealthy aspect.
So given that we know that there's such a deficit of residential units, why are we seeing such a slowdown in building, right? I mean, don't the builders recognize that, yes, obviously prices are high, and yes, rates are high, and therefore, buyers are going to have to pay up, but there's still there's a group of people that require shelter, as you say, and there's a massive deficit of units, and therefore there's an arbitrage that they can fill.
This is where my work is probably different than other housing economists. I actually believe the builders built accordingly to their demand curve. So in the previous expansion, everyone said we stopped building homes. Well, people forget we had the weakest housing recovery ever. New home sales missed estimates in 2013, 2014, and 2015. And in 2018, when mortgage rates got to 5%, they had a supply spike. So I kind of have this model with the builders. As long as inventory is kind of the 3-month average is below 6.5 months, the builders will build. It's really when they're under 4.3 months that their life is great. They'll do whatever. But it's really rare, actually. We didn't have it under 4.3 months in the previous expansion. We had it for a very brief time in this recovery. So the builders only build what they can sell. They don't care about the existing home sales market. That is their competition, right? So whenever they're in that inventory grows, those are cheaper homes with a geographical advantage everywhere that impacts their business model. So I thought the builders built very accordingly. In fact, one of my big forecast calls in the previous expansion is like, we're never going to get to 1.5 million total housing starts until years 2020 to 2024. Doesn't matter what people believe in terms of how much you need to build. The builders do not operate that way. So every decade that goes on, they see this massive existing home sales market. That's their competition. And if that inventory rises, it impacts their demand. It was different in the 60s and 70s because they didn't have this existing home sales competition. But we're now in the 21st century. So whenever rates rise and they see that slowdown, they pause. And in fact, in 2018, they paused for like 30 months. Right? Even just that brief supply spike when one of the builder CEOs said it was the worst fourth quarter since the great financial crisis. It really wasn't. New home sales were still low and housing starts were still low, but they are very mindful because they have to protect their profit margins. And what the builders did really in 2020 on, you could see this, they had so much pricing power that they pushed it onto the consumers because they could, and they made as much money as they can, even with lumber prices and everything so much. Their profit margins were really good. And now when rates rise, that's going to happen, right? They're going to hold back because they're worried about their profit margins. That's historically what would happen. So in March, I said new home sales at risk. I've already raised the recession red flag. The builders' confidence now has collapsed, more noticeably just recently. That looks all perfectly normal to me because you have to think of them as a business, not as a provider of shelter for the existing home sales market or for the general public, because deflationary aspects would impact their business model. So the builders have basically done exactly what I thought they would do post 2010. And even now, so much of my work over the years has been when rates rise, they'll slow down. When rates rise, you're never going to see a construction boom like people want. Because as long as they're there, they're gonna make sure to build enough to sell. They're never going to oversupply a market. Their real bread and butter is single family homes, but now you can see multifamily construction is picking up more recently. So that's a little bit different. But that single family residence, boy, that's already declining. They've kind of given up on that for this cycle. Until rates fall again, they're going to go very, very slow on construction.
So is there a level of inventory of both existing homes and expected new builds that would begin to, make the builders start to become enthusiastic about building again? I mean, it seems like, are they only using the change in rates to model demand? That's it.
They're using rates because if you think about it, the new home sales sector is really mortgage demand driven. It's an older buyer. It doesn't have the kind of 20 to 25% cash buyer in there. So they have to tightly manage whenever rates rise. Same thing happened in 2013 and 14. Rates rose. Whoa, they slowed things down. In 2018, boy, they just kind of paused on construction. And here, the builder's confidence has already fallen like a waterfall. Right. So they just know that, we have a problem. It took forever for us to build a home. So some of these people that went into contract at 3.5%, now that their home is ready, 5.5%, 6%, they can't qualify for a loan. So the cancellation rates were going to pick up naturally. And then they have that 7.7 months of supply, they have 6 months of that is actually just starting, right? They have about, 2.2 months of kind of homes that are being finished. Their actual product is actually less than 1 month. So they're going to take it very slow because they know they are very rate sensitive. And that happened in 2013, 14, that happened in 2018 and 19. And now the builder's confidence has just collapsed. And they're going to go, okay, we're just going to take it slow. We're going to make sure we sell everything. We're going to give it setups because it's actually a very small marketplace compared to the existing home sales. And they manage it well in that sense. And they're not working from a very high level. I mean, new home sales right now currently is below the 2000 recession. We're basically at 1996 levels. So they know what they're doing, but they also know they're very rate sensitive. And with all the home price growth gains that we've seen since 2020, it's more problematic for them. This actually shows up in the builder surveys confidence. And I always thought that builder survey confidence is the best survey we have because it's really profit driven. Some of these surveys have kind of ideological takes on it, but the builders confidence index has been falling. Boom, it just collapsed in the last one. Expect that to keep on collapsing. Then when rates come back down, there'll be the builder stocks in itself will rally and they have potentially more buyers, and just kind of look at it in that light. And it kind of makes sense why they're very, very rate sensitive, much more than the existing home sales market.
Okay. I mean, so the housing market is savagely unhealthy. People need shelter. Young people, as you mentioned, right? There's a demographic wave of, I guess, millennials that are seeking to form households and get on with the normal cycle of life. The builders aren't building. Higher rates makes it harder for existing owners to move, right? Because you've locked into a mortgage at a low rate. When you move, you need to then get a new mortgage at a new higher rate. That's obviously highly disincentivizing for existing owners to move. So, I mean, at what point? I guess there's something that's kind of missing for me here, because it seems to me that there's going to all of the factors are in play for there to continue to be a major deficit of units available. The home builders are suggesting that they have no confidence that that demand is going to remain strong for the units that they're building. And there's no evidence that we're seeing an increase in total supply, combining both existing homes and new homes on the market. So, like, under what circumstances do you foresee housing price growth moderating and or normalizing relative to median incomes, for example?
It should be more apparent in the second half of 2022, but it'll perk itself in 2023 as long as rates stay high. If rates come back down, that variable changes. But here's the thing with the mortgage rate lockdown. 13% of the country have less than 3% or under mortgage rates. About 38% have rates between 3 to 4%, and then another 30% roughly have rates between 4 to 5%. So majority of the country have low rates, but people naturally list every year. I've always argued that inventory actually grows when we have weakness in demand. So the last time total inventory grew was 2014. 2014 purchase application data was down 20% year over year on trend. Adjusting to population, it was actually the lowest level ever. Inventory grew. It wasn't much, but it grew. The growth rate of pricing went from like 10 to 12% to about 3 to 4%.
Is that because investment demand slows down?
Well, just mortgage buyers' demand slow down, right? So the mortgage buyer drives the market always. This is one of the reasons why I try to focus people into don't focus on large institutional home buyers. Like the Wall Street firms went from 0.4% to 2.5%. That's not a very big marketplace. The iBuyers are like 1% of all total home sales. So mortgage buyers actually move the show. So whenever mortgage demand gets hit, inventory starts to pick up because the days on market should grow. Now we're just at that phase right now where we see these between 18 to 22% year over year declines in purchase application days. We saw home sales go from about 6.5 million at the start of the year to about 5.1 million. Over time, what happens is that inventory builds itself up because demand gets weaker, days on market grows, new listings get added on. And even if you had a 3.25% mortgage rates, but you have to move, you're moving, right? Now, there are some people that can't afford to move anymore now because of the home price growth was so much and the mortgage rate has risen so much. I mean, I can make a case that there's a 4% spread in mortgage rates. We got to as low as 2.5%. We got as high as 6.5%. Mm-hmm. That is a meaningful increase. That's never happened, if you take the edges of rate moves. So those people are probably stuck, right? Not ready to go yet. But we're seeing inventory growing on a year-over-year basis. It's nothing spectacular, but in certain parts of the U.S. where they had more of the aggressive home price growth, they're already at 2019 levels. Places like Boise, Phoenix, parts of California are already there. Naturally, because demand has slowed down and the inventory, it takes longer to get out. It's just on a national basis, we're not back to normal yet. I do believe we can get there next year. Between that range between 1.52 to 1.93 million, just because if rates stay this high, demand will slow enough to where the active listings get back, because we never had a credit boom. So I've always said, in fact, one of the things I talked about last year in February of 2021, I said the reason higher rates work is because our homeowners are doing really good. You don't have to worry about them. But the growth rate of pricing could really impact demand. If things keep on going as it is. Of course, we had like 20% home price growth back then last year. So naturally, the listings should occur up higher and higher if demand gets weaker. And then we get back to kind of the pre 2020 inventory channels. Even back in kind of the early 90s, we had 1.52 million to almost 2 million inventory. Monthly supply went up to above 9 months during that period. So pricing can cool, but it needs demand weakness. What you won't see is the forced credit selling that we saw in 2000, starting in 2005 to 2008, and then the job loss recession. Homeowners on paper look great. Their mortgage payments as a percentage of disposable income is all-time lows. Their cash flow looks good. The nested equity is the highest ever. Over 40% of homes don't even have a mortgage. So you don't have that kind of backdrop. So it's basically going to be this unbelievable battle between good demographics and an affordability. And we already see that, inventory is increasing. It's just the speed of it is not what people thought. People thought it would be much faster, but a seller is a traditional buyer. Housing moves slow. They have to adjust the pricing. So this is something to look forward, toward the second half of 2022, but really the spring of 2023. But the X variable is that, 5 of my 6 recession red flags are up. The 6th one will be up next month. And then what happens traditionally is bond markets go down, mortgage rates go down. That creates buying power. Always remember, most Americans are always working. So the people that get hit first on the labor sites tend to be those with the least amount of education, which have renter financial profiles. So the chunk of home buyers are always there. But when rates fall, their buying power picks up. And that's how we should look about it. And that's to me the X variable on it could slow the growth rate of inventory down, possibly pause it, and even reverse it if demand picks up, because you have the demographics there. It's just a straight affordability issue at this stage.
Yeah, I mean, so we've already had a major affordability shock. And I think part of it too, well, actually, I'm curious, does any of your data suggest that there was maybe a permanent or semi-permanent shift in the marginal utility of housing as people they went through the pandemic, they started to prioritize a little bit more space. They spent a lot more time in their home and therefore recognized the value of having a nicer, larger home. So do you think that might have at the margin also had an impact on demand and prices?
One of my talking points before COVID happened was that I believe in years 2020 to 2024, people were going to move more. Naturally, there's expensive metro cities. If you need a bigger house for your family, that's why I did the kind of the rent date marriage act for so many years. In years 2020 to 2024, people were naturally going to go to areas where they could buy a bigger home if they needed it. If they already had a bigger home, that solves that problem. So even before COVID, that was the case. Then the work from home model came, which to me is the single biggest housing story of my lifetime, because everyone traditionally buys a house somewhat near their work. You could have people driving 60 to 90 minutes, but roughly you have to be kind of in the same area. Here you didn't have to. So you have people in coastal areas who have a lot of equity going, oh, really? I could move to the Midwest? Okay, I'm selling my house. Everywhere is cheap to people who live in California, right? And that's just the way it is. There's so many states out there that we just can't believe you can buy a single family home. So if you can work, right, and you need a bigger home, you're moving. So that facilitated more housing inflation, because here comes a buyer that has a lot more equity, has a lot more cash, and now they're competing against local people that don't have that kind of equity, and they're smashing them left and right, and seeing that was like, whoa, this is a real big deal. So that is a form of housing inflation that states like California export out to places like Texas, Arizona, parts of the South. So that was a big deal. I thought that would have happened anyway, but not to the extent to where you could work from home. And basically, even though you get paid less than you would have, maybe live in the city, you still have the unbelievable capacity to buy a single family home in these states, because When you live in New York and California or even Seattle, you just like think, oh my God, everywhere is cheap. There's no way, even myself, HousingWire, the company I work for, they're in Texas, and our conference in Frisco, Texas, I'm looking everywhere. I said, what is this? We have condos here that are twice as much as these big single family homes. I mean, Texas is still cheap.
For sure.
So that is definitely a huge factor that would have happened anyway, but it just happened in a bigger fashion because you can actually move. And that's kind of a one and done deal. That's it. You buy that house and then you're staying in there for like 10 or 15, 20 years. And it's a bigger home. So you're really staying in there. And if you work from home, you have so many advantages. So that to me was a really big lifetime event, this work from home model, which I'll be curious to see how this works out over the next 2-3 years, especially when a recession happens, because some companies said, nope, you can't leave. You can't work from home. You either here or not. Some companies don't have that kind of a labor dynamic. They have to adjust that. So some companies are already recruiting other people. Hey, you can come work from home. So it'll be very fascinating to see over the next few years, because traditionally what happens in a crisis stays in a crisis, but this has some long-term implications going out for decades if this is the case.
Yeah, well, it's more just sort of accelerating a trend that was able to evolve because of technological change, right?
Yeah.
So we might argue that we
Yeah.
would see work from home, a shift to work from home over the next decade or so anyway. But obviously, the pandemic massively accelerated that process.
We were rising from 1 to 3. We were actually heading toward 4% before COVID, which was a big deal. But of course, when COVID happened, it just blew up higher. So to me, it's like, I think you could get to about 15 to 22% of the workforce can be work from home. That might take some time, but could be the historical trend. That's actually a huge number.
Yeah, for sure.
There's certain sectors that can do this. There are obviously certain sectors that can't. You can't work from home. So if that occurs, that's a really big deal. And what that does is shifts bigger money into other cities. But of course, what's happened here is that all these areas, their home prices accelerated so much. Right. So it in a sense, work from home was an inflationary factor, because now you have the person is just one person, but the person has so much more money than other people. And it's just they outbidded a lot of people in local populations. Then those people go into smaller towns because they can't afford. So there's this interesting dynamic that happened due to the work from home model.
Could that, to some extent, I mean, if 20% of the population moves to a permanent work from home model, it seems to me that could go a long way towards alleviating the supply demand challenges, right? Because it's obviously a lot easier to build new subdivisions in the Midwest than it is to build new subdivisions around big coastal cities, both from a permitting standpoint and just from a amount of available space, less expensive labor, et cetera, right? This to me seems like, at least at the margin, one potential avenue for closing the supply demand gap.
The coastals are, fully lawyered up to fight construction all the time. So it's always going to be a struggle there. But there are also the coastal areas. These are really wealthy, well-to-do people. So they kind of run the show. I don't know how much even supply can really impact, because home prices are so abnormally high here. Just in my neighborhood, Irvine, California, my zip code is like the average single family home is 2.5 million. So it doesn't matter what you build. You can't build, a $400,000 single family home here. So the prices have gone so much. But in other parts of the U.S., yes, you can.
Exactly.
It's much easier to do that, and it's more inviting to go there, especially people that make good money. You can make really good money in California and not have a chance to buy a house. But if you make that kind of money in other parts of the U.S. and you can have a single family home and 4 to 5 bedrooms, stuff like that, yeah, why wouldn't you? Right? So California is a housing inflation mess. And the only reason prices stay up here really is because the people that own homes here do really well. But there's a segment of the population that just can never buy here. They're always going to be lifetime renters. And in fact, even before COVID happened, like 50% of the workforce in Los Angeles were like dual renters in one household. And we're not talking about college kids or something. We're talking about people in their 40s and 50s, and so that's one of the ways that they live is you have roommates, So we
Right.
had some of that alleviate, during COVID. People had money, they went and created new households, but it's just tough to get anything done in these coastal areas, especially near water.
Yeah, I have roommates too, four of them, but none of them contribute to the rent, sadly.
Yeah.
So it's speaking of rent, what do you expect for rents in general? And I want to then talk a little bit about how, because it's through rents that increases in the cost of shelter translate to the inflation metrics that we track, right? So let's talk about the rental market and what's driving rents. Why is there a lag? What do you expect from rents nationally? And then how do you expect the changes in rents to flow through to inflation metrics over the next several months?
So this was, I think it was August of 2020, and I did a podcast interview. It was titled "Cities Aren't Dying," and it was really about rent inflation is about to take off. I remember talking to the Washington Post in early 2021, and I said, "Listen, CPI inflation is about to take off faster than what people think, and it could stay higher just because shelter inflation is like 43% of CPI inflation is like 25% of it is rent. So we're about to get a really very aggressive uptick in rental inflation because everyone's working, people have money, and then the supply isn't there. So it's going to be a very violent move.
Well, it seems to me you either have to buy or you have to rent, right?
Yeah,
So, I mean,
yeah. So
yeah.
you have to have a choice. Now, rent doesn't traditionally fall really in a big fashion nationally. One of the charts I like to show is when you look at median rents at the start of the century, even with two recessions, you didn't see much of a decline. And the reason why is because most people are always working. And when you work, you're not traditionally homeless. So you need shelter. So you rent if you can't own. So here, again, the biggest housing demographic patch ever, not all of them can buy, but they can rent, right? So shelter inflation is took off in a vertical way, not shocking. It's been a theme of my work. Over time, that growth rate will slow down just because, I always say they have to be able to pay that rent. So it's not like, they can't afford it. If they can't afford it, you don't have that kind of rental inflation, right? So deflationary aspects mean that, okay, people that can't afford it, those rents have to go down. We did not see any of that because people make money. They got more money. They're getting wage growth. And that's the thing that I said to the Washington Post last year. If you get wage growth, rent inflation is going to get worse, right? Because landlords have that kind of pricing power, and that's what happens. So wage growth is really picking up. We see it especially in the Atlanta Fed data. That means shelter inflation is sticky. And then on top of that, now that rates rose and home prices rose, you have a lot of renters, first time or single renters that there's no way I can buy a house now. So they're staying in their homes, their rentals longer. So in that case, shelter inflation is a little bit more sticky, and rent inflation doesn't really have these big collapses. You need like major job losses. Even after the great financial crisis, the shelter inflation itself went negative for just like a few months, and then it just came back up. So it's really rare to have deflationary collapses in rent, but we built a lot of multifamily construction that'll come online that'll hopefully alleviate it. But it's not one sector that has these really big declines over the decades.
Right. But what are we expecting for rents nationally in terms of
the growth rate should naturally slow just by the laws of big numbers, and more supply is coming on. So over time, the growth rate should slow. We just have a very abnormal brief time in history that we had this massive demographic patch, wages kicked up. So some of the rent inflation data looks crazy, like 20-30%. That growth rate should slow by just the laws of big numbers, more supply come in, and you can't really keep on charging 20-30% rent over year over year. People don't make that kind of money. So just by that factor, the growth rate should slow and more supply is coming. Think of this: we have over 142 million units already. So when we talk about supply coming in relationship to, let's say, a couple 100,000 apartments coming in, just know that that percentage is low to the total units out there.
Sure.
So rent inflation growth rate should slow only because the growth rate was way too hot to sustain itself. It's kind of like the housing bubble years. Demand was way too hot. The credit demand could not sustain itself. Credit tightened, that demand collapsed. Here, it just the growth rate slows down. But again, people need somewhere to live. Majority of people are always working, even in a recession. So it's just a marginal difference of those people that can't pay that rent. And of course, it's much more difficult for renters in an inflationary time frame. The best hedge against inflation right now, if you're an American, is your 3% mortgage rate, right? Or all the homeowners, all the people that bought homes in the last 10 years, their fixed debt products, their wages rise every year. So this burst in inflation, their total payment of their home is much lower than what it was when they first bought it and after they refinance. So their cash flow is really good. It helps them alleviate any kind of inflationary issues. The renter does not have that benefit. You know, a lot of my friends I see that are renting, they see this, oh my God, my rent went up this. So you get hit on all ends: food prices, energy prices, shelter prices, where a homeowner is just sitting there thinking, hey, it's pretty chill here, you know. So
Yeah, and there's not, I guess, the same, it's intuitive but wrong, I guess, to sort of link the cost of rent to the cost of buying, right? Because as you say, such a large fraction of homeowners have locked in rates, and many of them have locked in lower rates, right? And so they are not feeling pressure to raise rents because their cost of owning the properties hasn't really gone up much, right?
Well,
So
it's the cash flow. You know, I always tell people I'm the worst real estate investor ever. Like, I have one real estate property. I paid it off, paid the mortgage off. I've never raised rent in 9 years. I didn't even collect rent during COVID. So I'm on a cash flow basis. I've taken like a huge hit with that. But when you think of cash flow investors, they had a fixed payment and their rent's gone up. So their cash flow gets better and better and better, right? Their mortgage rate does not go up, right? Especially if they're using a 30-year fixed product. So, and a lot of these people even have homes that they purchase with cash. So their cash flow looks great. Like, people tell me, why don't investors sell their homes? Are you kidding me? This is how they're retired. They just collect the rent, you know? I even ran numbers for myself this year just to see it. I was like, okay, what if I actually charge what the rent would be? I was like, wow, no wonder everyone does this, right? The cash flow looks good. So yeah, for a lot of those older time kind of investors, boy, their cash flow just got better and better. And here is the biggest rent inflation in years. So guess what? They're making a little bit more money. They're not giving up on that house because that's where the cash flow is. So that's a much different than, let's say, a flipper who's trying to remodel a home and then sell it right away. You know, the growth rate of pricing could impact that business, especially if you have to carry over the cost. So, but that segment of the investment society is doing really well. The rent's gone up, and they just get more and more money for that.
Yeah, it's just amazing that, I guess, property owners, just continue to live with lower and lower cap rates on their, and it doesn't really matter except to the marginal buyer.
I've always said homeowners have it so good. I mean, so many of my charts over the years, it's just like, this is the last group you should worry about. I mean, on top of everything, their cash flow is good, their FICO scores are great, their fixed products, there's no recast rates, their nested equity positions are so massive right now. There's still $2 trillion in excess savings in the economy from the COVID-19. So even though the savings rate fall, that's just the stock versus the flow, there's still that excess. So homeowners are doing really good. Homeowners are doing really good. The renter, of course, is different because they don't have that fixed shelter cost.
Right. So, I mean, the only way that we get some sort of, I guess what I'm looking at is we've had a major shock to the cost of shelter. We've got disincentives for home builders to increase supply. We've got disincentives at the margin for existing homeowners to move because they're going to have to move from a low mortgage rate to a higher mortgage rate, so their cost of shelter goes up. How do we equilibrate this market? How do we create a market that is not permanently deleterious to new generations coming up through? I mean, the relative cost of shelter for a millennial relative to a baby boomer or an early Gen Xer is going to be 2 to 2.5 times.
So I made a case recently on why I believe we can get to 2019 inventory levels next year. And currently we're at 1.26 million.
Yeah, but even if we do, let's say that we moderate the rate of growth. Let's say that growth slows to zero. Let's say it stays at zero for 3 or 4 years. Like, it still is going to take many, many years to work off that shift higher in prices.
Yeah,
right?
it's gonna take. I've actually run models on this too. It would need, for me to get my price growth model back, I would need nominal home prices to fall 12 to 18% nationally to get that back to 2024 levels. That would mean a job loss, recession. That means rates stay higher. The government doesn't do anything to help consumers. This is the quote unquote housing dilemma. So much of my work is the housing dilemma is that we've created a system that really is designed to keep home prices up. The one time that we let it go was because of a credit expansion boom and bust. In theory, if we wanted to, we could run forbearance programs in every recession and nobody loses their home, ever.
Right.
We can do that if we wanted to. I don't think they're going to have an open forbearance like we didn't. But if we wanted to, we could do that because recessions don't take that long compared to what it was in the 1800s. And then people will get a job back and they keep in their homes. We can do that if we choose to. But there is a price to pay of affordability. And we finally got caught in a very bad way. We got away with it for so long. And the housing crash, if you look at other countries like England, New Zealand, Canada, their home prices are so much higher than their per capita income. We look so cheap compared to the rest of the world.
Agreed. Yep.
But they never had the housing crash we did.
Yep.
Right. So my concern is that this is a difficult problem to solve because the builders need to make money. I would argue that if you really wanted to facilitate something, the government would have to pay people to build homes during a downturn to offset the builders' lack of construction. Something that I wrote last year with looking at the history of inventory and building going back decades, all the old stock of homes that we have that need to be tear down and build. There's all these different variables in there. And it's just very hard, right? It's just a very hard thing because for us to get price declines, you need demand to really get weak. If there's a job loss, recession, people lose their homes and foreclosure. You need something like that to balance it out. And, once that forbearance came in and it was such a successful program, if things ever got into a really bad state for the U.S. economy or there's some kind of other shock, they in a sense could always fall back on that, which means more people stay in their homes. The only way longer term is, to me, it's the baby boomers dying. And that's something that, there was this marketing material in the last decade. They called it silver tsunami, that all baby boomers were going to sell their homes starting in 2015 to millennials that can't buy, which means they have to drop their prices around 50 to 70%. That was never the case. It was a grifting marketing tactic. But in time, the baby boomers will die. There is no Dorian Gray labor market, so you can live in your house forever. That shift of housing has to go somewhere. But this is a death premise, right? That's coming down the line. This is also one of the reasons why I've always said you're never going to have a construction boom, because toward the end of this decade, we're going to get a lot of baby boomers passing off, giving their homes to their children, which means it's a wealth transfer. Whatever they do with it, that's their thing. That won't change ever. That's just years down the line. My work from years 2020 to 2020, it stops in 2024 for a reason. The demographic push from the millennials, that little bump that we had, kind of goes away. We just go back to trend. And if more people are dying, you get a little bit more supply. That to me changes some of the dynamics. We are still early in that process, but nobody escapes death. You don't take your homes with you to the grave. So that is something down the line that we can think about maybe for more supply. It's just not something that's happening.
Well, I mean, my parents are early boomers. They are currently 71 and 72. So given, median mortality, they've still got at least a decade more of healthy lifestyle and another, 5 years of needing more healthcare. Maybe they need to move into an assisted living, that sort of thing. But I mean, it seems, and they're early boomers, right? So, it's we're not going to see, I think, at the margin, a major supply of new homes from boomers for
the boomers also
the next 10, 15, 12, 20 years.
The boomers didn't downsize either. A lot of people are thinking they love their homes. See, that's one of the things about us in America. We love our house. We have TV shows to tell us what to do with our house and how to fix it up. And great. It's our thing. You don't turn over something that you spend that much money and time in unless you really need to. That's why I've always tried to stress to people, if you look at total inventory in America, it was slowly falling every single year. People were saying, oh, we're on the verge of a crash. And then here comes the biggest housing demographic patch ever in history. Oh boy, lowest mortgage rates. Oh, we just broke to all-time lows in inventory with this big difference. What did people think were going to happen? We're going to have like a 40, 60, 70% home price? No, the exact opposite happened. The most historical housing inflation in recent modern day history. We all lived through it. When we all die, we all could say that we experienced it. Hopefully we never see anything like that ever again, but we paid the price finally for not having enough product out there, not just for home buyers, but for renters as well. And then we got hit on both ends, and getting hit on both ends is painful.
But there's a structural disincentive, right? The home builders also want the home prices to continue to rise, right?
That's how they make money.
Yeah, there's nobody that can affect the supply of homes who wants home prices to fall. And so, it seems like there's it's almost structurally intractable to determine how you get the right level of supply to bring housing prices back into a range that wouldn't be, excessively onerous on new home buyers.
The only thing I say is that recently home price growth went up so much that the demand weakness could create natural inventory. But it's you would need supply to really take off, a demand to really stay weak for a while, and then you could see price declines. But again, you look at the history of nominal home price declines, it's rare. It does happen. You don't have a credit boom and bust here, but you've had an accelerated of home price growth. Me, for myself, I'm like, how do I get my 12 to 18% decline in 2.5 years? Man, that's going to be tough, right? Yeah. But we try to model things out and think about the economy, but then we have to incorporate recessions, rates going down, jobless. There's all these different live variables that we have to track for housing economics. But man, the damage was done. That was a brutal 2.5-year period. And even recently, I wrote an article for HousingWire. Home sales are down, but wire home prices are up. And it's designed to show people that, boy, this was always in the works. And people just don't sell their homes to be homeless. It is a fascinating concept some people try to convince me on, but they don't do that, especially when they're working. If you told your wife or your husband that, or your kids would throw every toy they had. They're like, Dad, you're working. What's your problem? Stop being a little whip. So people don't sell their homes to be homeless, or people don't sell their homes to rent at a higher cost unless they need to move for a job or something like that. So the distributional shift of inventory has changed post 2008, which makes it a little bit more problematic for housing inflation. And it was awful to see. Hence the savagely unhealthy housing market, just because the worst fear I had is us getting stuck at this low level for a duration of period of times. It happened. And rates didn't get up high enough to really change the cycle. So we're working our way back to normal. But again, housing moves much slower than the stock market.
Do you have children?
No.
Oh, okay. I mean, I have 3 children. And I mean, I have to tell you that one of the things that I worry about fairly consistently is, where are they going to live? Right? How are they going to be able to afford to form families and have a reasonable life even with decent jobs, right? I mean, do you have any thoughts on what happens there?
A lot of people didn't think millennials could buy homes, but millennials have been the biggest home buyers for the last few years. Dual household incomes solve a lot of housing inflation issues for people, especially if they have two good jobs, or we call them DICE, double income college educated. So this is why millennials are the biggest home buyers, especially last year they were the biggest home buyers. But there's a certain group of American households that just don't make enough to buy a house, so they have to rent, or they have to move to somewhere cheaper. So we saw that dynamic, of course, even with people who make good money, they could buy more of what they want in other cities. I expect that to be the case for certain households always out there. But yeah, it's a housing dilemma. It's a problem. And there's no real quick, easy solutions. I was hoping that 3D printing would be more prevalent or something to that nature, but it hasn't really taken off the way I thought it would. So we just have to deal with it one day at a time on the economic side and see where we take it from there.
Gotcha. And on the economy side, maybe let's just finish with, you said you've got 5 of your recession indicators are firing.
Yeah, 5 of my 6 recession red flags are up. Of course, we're coming from the longest economic and job expansion ever in history. So only 3 of my recession red flags were up before COVID, but COVID was a shock, very brief recession, fast recovery. The last time I had 6 recession red flags up was in late 2006. So there is a lag impact. It depends on what's happening in the cycle. So my 6th one will be raised next month. And traditionally, my work is boring progression economic model work. It just basically shows you an economy expanding, going into recession, expand, and the historical data lines that go around it. We adjust the variables to what we're dealing with right now. Of course, the Russian invasion was a new variable for this year. We try to incorporate everything. But the reason I think you have to be an economic person to be a housing person is that traditionally mortgage rates fall into a recession. So you have to weigh that into the housing discussion, just like in a recovery, you'll have to weigh up rising mortgage rates as well. So that's going to be the interesting aspect because when my 6th recession red flag is up, then I talk about the economic cycle much differently, but it could be 3 months we go into a recession, or it could be 15 months. But there's different things to look for. But traditionally speaking, if you go back decades, there's certain things that always happen before a recession. You have to block out all the noise. You have to be unhuman. You just have to look at numbers, right? Numbers are the closest thing to the handwriting of God. Just get the human element out of it and just follow that data. It is terribly boring. I know it's not very exciting. That's why I don't have a YouTube page. So it's just here to design, because if economics is done right, it should be terribly boring. You always want to be the detective, not the troll, and let the numbers guide you to this eventuality. And then at that point, then you have to create a recovery model, because it never stops. That's why I'm not the recession forecaster. Says my models don't ever stop. They just continuously move. Just like economics, it's like human life. It continuously moves day in and day out. It doesn't have a set date.
So what's the 6th shoe to drop then?
The 6th recession red flag is leading economic index. It's a set of 10 different variables. Traditionally, it falls 4 to 6 months before every single recession. I kind of knew it peaked out a few months ago. Today, actually, it came out today, another leg lower. It's on the 3rd month of it, but I always say I have to wait 4 to 6 months before I raise it. I mean, I could, in theory, raise it today if I wanted to, but I'll wait till next month, and then we just talk about it. And when you see it in the data lines, you can see it. Well, boy, it really does fall before every single recession. You get to certain stages of the economic expansion. Of course, COVID-19 was an anomaly. The U.S. economy was actually getting better toward the end of 2019, and 2020 data actually was looking good. But that was a shock and a fast recovery, much different. This is more of a traditional cycle right now.
Gotcha. Okay. Well, Logan, thank you so much. That was a whirlwind tour. I have to say that I haven't really gotten into the stock and flow of the housing market in that way. I obviously watch it closely, but this was a very interesting and novel take. So I really appreciate you sharing with me and with those of us who are listening in the background. And maybe we'll have you on next year to evaluate how things went.
Yeah, perfect. And always remember, be the detective, not the troll. Follow the numbers. I'll guide you there.
I like it. All right. Thanks, Logan.
Thank you.
Have a great day.